I'm a believer. I believe that the world is good.
And I know that the world is not good. That questioning yourself and questioning yourself in dialogue with someone you respect is both pleasant and sometimes extremely insightful and useful sometimes.
Having trouble understanding what your trader buddies are saying? Here's what it means when they say catch a bid. The term catch a bid is in reference to the stock's price action. The bid price is the price at which you can sell a stock at. When a stock continues to go down, so do bids, meaning the price at which you'd be selling the stock is continuing to go much lower. If you miss it, you can't catch a bid.
I started trading around 2018, as soon as I got out of college. Stumbled upon a couple of different YouTube videos and learned that way. Truth or Skepticism with Dylan Radigan was actually kind of what really caught me in the early stages, because Dylan was sort of the skeptic, and like I was a skeptic as well. And Tom was able to sort of convince him, and that was kind of my favorite show from the beginning. The fundamental principle that present fear of future uncertainty is fundamentally overpriced. In other words, volatility and selling volatility is the key to getting a statistical advantage in financial markets, is the biggest takeaway. And that's kind of just the overarching principle I follow.
Dear Braden, big thanks to you and the nerds for the wonderful tech support. Of course I back everything up to cloud, because I'm 60 years old and I know what a cloud is. Yours truly, Larry.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
No, your office is right near a different. You're like closer to the.
Near what?
This is English. You should watch him read.
From the smart mouths at tastylive.
Oh, yeah, it is Wednesday, October 2nd, a little bit after 5 p.m. Central. You know what that means. It's time for Tasty Live's evening show. Tasty Live's evening show, a little podcast called The Price of Truth. The podcast where we explore the incentives that govern our world. The idea is simple, my friends. Have great ideas, come on and share great. Excuse me. Let me say that again. The idea is simple, my friends. Have great minds. Come on and share great ideas. Today we have with us one of the best minds here at Tasty Live, global head of macro, the one, the only, Ilya Spivak. Ilya, how you doing? Welcome to our first 90-minute conversation since, 2 years ago.
At least first 90-minute on air. You and I have gone plenty longer than that off camera.
Fair point.
And that we would be able to do were they to let us, but they do have to put us back in the box at some point. I'm good. I like what these markets are setting up for this week, and it'll be interesting to see how it all resolves. The next 48 hours should be mighty interesting.
Yeah, I shouted you out yesterday. At the end of the episode, I said, somewhere out there, Ilya Spivak's got a big smile on his face.
Right.
Given what happened in markets yesterday, we'll talk about that and much, much more. But before we do, let's say what's up to the people. Shout out to everybody watching on tastylive.com. Head on over there if you'd like to check out. Tasty Live's got a bunch of other stuff besides just the content we do here. A bunch of other learning tools. Ilya, my man, is writing a bunch of content as well as other content creators. So there's a bunch more going on here than what you see on YouTube. Make sure you head on over there and check it out. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't have both of them, you should probably go and get them. But if you want to be part of the conversation, and the producers are going to throw up this chat on screen, and if you want your name and comments to be on the screen, there's only one place that you can do that, and that's over on the evil Google YouTube. So head on over to YouTube, type in Tasty Live. Click on the live tab. You'll find my big inflamed head somewhere on a big red thumbnail. Jump in and introduce yourself. Everybody that's in the chat right now, you know what to do. Let's start spoofing that Google algorithm. Say whatever you want. Tell us your name. Tell us where you're from. Just type in random ass characters so we can spoof the Google algorithm into placing us in front of as many people as possible, and we can save the world one view at a time. My good friend Ilya Spivak, there's nothing left to do but to do it, my friend. I'm gonna start this conversation very open-ended, but there are a ton of very specific topics I wanted to cover with you today.
Sure.
So today, a bit of a mixed bag, sort of an inside day. Not much of a range around risk assets, slightly positive. Yields moved a little bit higher. So I open-ended question. We are halfway through the week. What was your take on risk today and risk movement so far for the week?
I mean, it seems like today was a bit of a hangover from yesterday. Obviously, yesterday the markets got smacked around, and it was not for any economic reasons, but because Iran decided to shoot hundreds of missiles at Israel. So this is not your kind of, here's a piece of the macro narrative, and the markets evaluated that narrative and then responded accordingly. No, this was hopefully a one-off, but in any case, an off the calendar, off the radar kind of development. And wouldn't be unusual that as everybody's kind of sitting on tenterhooks, waiting what's going to happen next and which shoe is going to drop next, everybody's kind of waiting to see what happens. I thought the price action in crude oil, which we hopefully have up on the screen here, that's telling, because what you saw was this spike into the range high around 71, 70, 72, didn't break out though. And then you sort of settled. Then APAC markets, European markets got their crack. So you see this long wick on it overnight where it spikes again into the highs. They sort of take their opportunity, especially in APAC markets, especially while it's thin because China is on a week-long holiday. They take their stab at it. It comes right back in. So nominally, crude oil is up today, but if you look at the candle structure, what you see is after that spike high, you come right back down and back into that range. So I think the markets are not running away with the idea that there's escalation in the wind. I mean, we just heard from Iranian President Masoud Pezeshkian at the UN. We will not be goaded into a regional conflict.
Yep.
We just heard from Israel.
Effectively, it sounds like the message from Iran was, we're done. If you guys are done, we're done. And
like April.
Right.
Like
and
April.
And I think the question next is, does Israel leave it at that? Or is there a response? And I wonder. It
sounded today like they answered it. So that's exactly the perfect transition. That's exactly where I was going. We heard from officialdom in Israel today that essentially there's going to be a response, and this was obviously very serious, and they have to respond, but the response will not trigger a regional war, which is an interesting thing to guarantee up front. Be like, no, that's not what we're doing. And that sort of restates again, the primary actors here don't want to go head to head. And I think that status quo holds.
So from your point of view, we'll stay on the Middle East conflict before we go.
Sure.
And there's so many themes and threads to pull here. So let's start on this. Do me a favor, everybody. Now that we've got a bunch of people, shout out to everybody in the chat. I wish I could go and shout you out individually, but we've got a lot to discuss today. Your names are on the screen, but do us a favor, hit the like button as you come into the chat, if you'd be so kind. So I suppose, what is your interpretation of what do you do with this single factor the Middle East conflict, what do you do in terms a trader that's looking for risk and opportunities? Clearly, there's a read through here in crude oil. I want to know what
Yes.
your thought process is. There's obviously been, with these war escalations, there are other read-throughs and defense contractors. I've got Lockheed Martin on the screen. There are potential currency implications, yield implications, all of that stuff.
Yeah.
So I'll just bring it back to the question, which is, what do you do as a trader with risk and opportunities here? What's your direct read-through, and how do you play it?
I think the way that I've been approaching this basically all year is the same way that I'm looking to approach it here. I'm just kind of waiting for the implied vol readings to come in, for the spreads to narrow, so that when you go and you price up an options vertical, be it USO or CL or MCL, whatever it is, they look a little bit better than they look now. You're not, if you went to go and price up a directional put
verticals are going to be
crude
hard because implied volatility is so high.
because implied volatility is so high.
Yeah.
And so for me, I look at this and I go, the thing that's worked for me all year has been to say, every time that there is sort of the risk built back into the market, that this becomes bigger than what it is, that risk fades because none of the protagonists actually want to go there. And I think that's basically my approach here as well. I'm just waiting to re-enter short again, looking for vol to come in a little. I don't really want to try to extract the vol by selling puts. My view is more directional, and I want to let kind of the spreads narrow a little bit in order to do that. But I think ultimately what I would like to do, be it through MCL or USO, is to put on a put vertical here to come back into the swing lows from September as a start, and then we'll see.
So basically, you're saying, so implied volatility is high, so there's some different optionality here. One, you could just sell vol and be directionally neutral. That doesn't seem to be your style, and you have a directional opinion, so that's out for you. Also, selling puts outright doesn't match up with your directional bias, which is you have a short bias here, but it seems like also the price level
I could sell
here,
calls.
Right.
That's one option.
Where I'm going was 71. It seems to be, if I'm extracting, 71 doesn't seem to be a rich enough price for you to go short. So is that fair, or do you like shorting at 71? You just don't like the trade construction of selling calls or call spreads.
I don't like the trade construction at the moment, and I don't see confirmation that we've hit some kind of a turning point. We're holding at the underside of what was support and is now resistance on a second test again. If this starts to show some signs of rolling over, I'm going to be much more kind of itching to get in, and I might even accept some risk reward. That's not, I mean, I usually look for at least a 2-to-1 positive skew in my construction. So I'll look at something and I'll say, okay, I don't want to risk more than 1 to 2% of equity, and that's where I want to lock in a risk profile on a vertical, and then look then for the reward on the vertical to be at least double that risk or thereabouts. I'll accept 1.5 times or something like that here if the turn is happening, because you can't get too cute by a penny and then miss the move.
You want the penny, or you want the what is it? You want the penny, or you want the position? So let me ask you this: every macro guy, it seems like, I shouldn't say it like that. What I should say is, on escalating Middle East tension, people are shorting crude. That the market is just not believing it. They're hammering it on what should be an escalation, what normally would be a bullish headline. The market's fading this thing. So my question to you is, when does that trade? When are you at risk of that trade becoming too crowded and actually seeing a potential short squeeze to the upside? Do you think that's a risk here at all?
Yes, I think it is, and I think what would have to happen is it wouldn't most likely come from geopolitical risk. It would come from expanding demand expectations. And there's basically a pair of things here. The first one is we don't know if China's stimulus is going to work, but maybe it will. So the funny thing that's happened with China is, of course, they've talked up their markets. They've successfully convinced their markets to go higher. They haven't told them anything of substance. They gave them more monetary stimulus that's failed for 3 years already. But the thing that really activated them was Xi Jinping and his 23 closest friends came out of their meeting and said, fiscal stimulus is now on the table. And that's where the market. Yeah.
Real quick, because I know you're dialed into this and this whole Politburo story. Do me a favor, if everybody else is not caught up on what that meeting was, that's beyond the monetary PBOC sort of stimulus a couple weeks ago, then you get this new fiscal sort of impulse that came from the Politburo. Can you just explain that if anyone hasn't been following that narrative real quick?
Sure. So
as quickly as possible.
So the Politburo is essentially the core group of 24 people that actually run China. It's the central committee that essentially is steering China with Xi Jinping on it. And Xi Jinping has so thoroughly cleansed China's government of any opposition that he basically runs it. And everything else is staffed with yes men. So the key issue in China since the exit from COVID restrictions has been that the economy has not picked back up. Everywhere else, restrictions were taken down and you saw a burst of energy, a burst of growth, US, Europe, you name it. In China, it didn't hold. It held for basically a month and a half, and then everything came fizzling down. The economy has been in a deflationary spiral for 5 quarters in a row now. And it's because monetary stimulus hasn't worked. So monetary stimulus, where the central bank comes out and says, banks, we're going to lower your reserve requirement ratio so you have more money to lend out. We're going to cut overnight lending rates. We're going to offer extra lending facilities to companies, especially if they want to buy stock with the money, like stock buybacks. We are going to give all this free money to the economy and say, go, grow the economy, borrow the money. And the answer has been no. Private enterprise, state-funded enterprise, investment down to basically zero. Consumption, gone. If you look at the current state, this is from the PBOC's own numbers, deposits at household bank deposits, record high as of the second quarter. There's just no demand in this economy. The PBOC polled consumers, and they favored 58% saving over investment and consumption. So they asked them, with your future income, what do you want to do? Do you want to invest? Do you want to consume? Do you want to save? 58% said save. So there's no consumption, which is how you end up with a deflationary spiral for 5 quarters in a row. Things go on discount because they're not being sold. That's why the price of things is going down. It's trying to basically discount demand into existence. And so what we're looking at then, when China starts to announce this stimulus, and it's again more rate cuts, more money, everybody rolls their eyes and goes, yeah, okay.
Would you say part of the reason they're rolling their eyes is they've been introducing monetary stimulus, but the general point of view from the market is it's not like a money cannon, it's not a bazooka, it's not going to be enough. So they're doing like sort of these small gestures, but it hasn't been gigantic enough for the market to sort of say that this is enough to resolve the issues. This is enough to take risks. This is enough to change consumer behavior. That's sort of been, up until recently, the position and the narrative of the market. Go ahead.
I think it's more than that. I think it's that as ever, right, with monetary policy, you can try to incent people to spend money with monetary policy. You can give them very cheap credit and say, look here, you can borrow very, very cheap. Don't you want to borrow to consume? Don't you want to borrow to invest? Don't you want to borrow to grow your business? And if the answer is no, well, then that's it. There is no stimulus. It's an incentive to drive the economy. It's not demand. This is why, as an aside, after the 08-09 financial crisis, when the Fed launched QE, cut rates to zero, we struggled for almost a decade to get inflation to even approach 2%. Whereas everybody was yelling up a storm saying, oh my God, they're printing all this money, which they weren't doing really, but that's what they said. They're cutting rates to zero. This is going to be incredibly inflationary. Only not. Why? Because consumers were rebuilding their balance sheets after a credit crisis. They didn't want to spend. They didn't want to take the money. It took forever. The difference in COVID was there was lots and lots of fiscal stimulus. The government literally created demand by spending. This is what they want from China. This is what markets want from China. They want the government to go, okay, the private sector doesn't want to buy stuff. The government needs to buy stuff. It needs to create a level of activity to kickstart this thing.
All right, let's
and
have a
create
little
confidence that things are starting to come back alive.
let's have a little back and forth here. Let's have some fun. Okay.
Let's do it.
And I'm just playing. I'm kind of playing devil's advocate, but I'm actually talking my book at the same time. And you're always
Let's
a gentleman and a scholar when we do this, and it's always a little bit fun. So the point of view of Ilya Spivak is the economy. When you look at the data, and the consumption patterns today is not validating the move in risk assets. If I'm teasing out what you're saying, and maybe I'm straw manning or steel manning your position, but I'm kind of that's
In
kind
China
of
or in the U.S.
in China.
I would think at the moment we don't know.
Fair.
Because we don't have specifics on what any sort of fiscal spending is going to be. What we don't know is whether the hype, which may be validated, we don't know. But we don't know that it will be validated because for 3 years, Xi Jinping and his yes men have been allergic to the idea that the government needs to spend money to kickstart growth. So at the moment, what this rally in the market is, other than something that the PRC mandated and basically said, and this is the PRC now, these are not exactly open and free markets. They basically said, go buy stock. And you're going to do that if you're in China. So aside from that, the sort of genuine aspect of this rally is expectations that there's been a head change for Xi Jinping and fiscal is coming.
Yep.
Now, when and in what size, we don't know.
Right. So I would say that when the data validates that, the market is a discounting mechanism for the future, right? It's looking at the potential incentives and going, I don't know what will happen, but it seems the incentives may drive towards this potential outcome given the discounted probabilities. So therefore, I like the risk to reward of taking this bet. I don't know what's going to play out. I just look at the incentive structure and I like the risk to reward. And if you wait until the economic data confirms what you think could be the future in 9 to 12 months, you've probably missed the majority of the move. So here's
very true.
So what I would pose to you, right, is the point of view that I had and have is that there are 280 instruments that are US listed Chinese securities, okay? The total market cap of those after a 20 to 50% rally in a lot of those underlying names was $800 billion yesterday. Less than that, 700 and change, right? Which is about the value of a Tesla. So, that doesn't mean all of China is trading for $800 billion. It means the U.S. exposure is worth $800 billion. So my point is, it seems like for various reasons, and you can give me all the reasons, the accounting problems, their economic problems, the potential for an RSX type situation, a delisting or an absolute freeze of those types of assets, all that stuff, I get it. But at some level, you look at all these instruments and you go, that doesn't seem close to the realistic fair value of these assets. If you see 9 months into the future and a Chinese PBOC and fiscal response that is looking as if it's going to play ball. And it seems to me what the market is doing is truing up or finding something that is much closer to a fair value if that ends up being the future case in 9 to 12 months. I think the market was so mispriced for that potential. And everybody I talk to, Ilya, they say the same thing. You can't trust the numbers. Xi Jinping, he kicked out, he did whatever he did to Jack Ma. They rug pulled all those education securities. It's like, I get it, but that's what's in the price. And you're seeing something that's discounting a potential different future. Your response?
I agree with you. And I agree with you that it doesn't matter what China did before or the accounting things and all the longer term stories. Those things have all been there. They all will be there. China is in the middle of a horrible demographic situation. They're probably aging themselves into obsolescence.
Isn't everybody though?
Not the U.S. And not a lot of other places also.
We're at a 1.6 fertility rate, right? That's nowhere near the population replacement rate of 2.2.
Yeah, take a look at what's going on in China, and also consider that China's growth engine is a labor-intensive growth engine, and we have the lovely benefit of having very fertile neighbors with whom we have great relations. This is why there's been all this talk about nearshoring and reshoring and friendshoring. Congratulations to Mexico today. They have their new leader in place, the first female leader in North America. And they're very much a subject of conversation ever since COVID, because the other big headwind for China, of course, is they, as a function of COVID, have lost a ton of market share as the value-add middle step in the global economy. COVID basically gave everybody an opportunity while everything was locked down to shift supply chains with impunity, which they couldn't do when those supply chains were running so hot before COVID. So all of those things are there. None of those things are actionable for what's immediately going on. Those are all bigger picture, longer term, we'll see whatever, years out kind of thing. The reason that I am not a buyer of this tactically now is much easier, much more straightforward, much more right this instant. If you look at how the market response to all of this has worked out in mainland shares versus any China proxy you want to look at, it's a different story.
Why do you think that is?
Look at copper. Look at the Aussie dollar. Where is this optimism that we're seeing? It's not there. Copper spikes, then comes back down. Aussie dollar can't break its high. How come? How come all these measures of domestic stocks are surging, but anything that is immediately a reflection of a stronger business cycle outlook for China cannot rally? Why?
Can I answer that?
Yes.
Or do you have an answer? Or do you have
I do.
Okay,
I have an answer.
Then. Let me hear yours.
The external market doesn't buy it. At least not yet. Because domestically, in these very small sandbox that is mainland shares, where Xi Jinping is king, he can come out, because the economy is closed, he can come out and say, hear ye, you will go buy stocks. We'll even give you the money to do it.
Yep.
Just go buy them. It's window dressing. And that market isn't very liquid. So it's not all that difficult to push that market around.
Let me give you the other side. The other side would be that the U.S. So what happens is, and I know you know this, but for the people that don't, the U.S. instruments, the U.S. listed instruments, trade at premium and discounts to their Chinese their Chinese counterparts for various reasons. And there are times when Chinese company CEOs get pissed at the discount that the U.S. listed equivalent will trade at relative to their Hong Kong or Chinese counterpart. And they will threaten to delist because they'll say, you guys don't know the real value of this company. And if you don't, if this doesn't trade at fair value, we're going to delist. We've seen that since like 2015. They do this all the time. So my devil's advocate position to you is the reason you're seeing it in the domestic market, but not potentially in the Hong Kong and in the Chinese market specifically, is because these things were trading at a dumb discount relative to their foreign
which is why I bring up the Aussie dollar and copper, which aren't equities at all.
Right. But wouldn't you say that's multi-factor, right? And I would say that copper did rally. It was at $4 and now we're at 460.
It very conspicuously rallied and then failed as a matter of fact. Just look at that spike on HG futures.
Are you talking about this?
Take a look at
Are you talking about earlier
right
this
there?
week?
Exactly. The most recent announcements, right? You get a massive spike through 4.7, attempting to break out. It doesn't even last a day. It can't even hold up for a day. It caves back in on itself. So how exactly does one believe this narrative? Look at emerging markets excluding China. If there is this belief in, I believe it's EMXC, if there is a belief here that China is coming back, that should be good for other emerging markets because China is a big buyer of their wares. China is ultimately a middle step in the global supply chain. It is a big importer from other emerging markets because that's where all of the raw materials come through that it then processes and gets more finished before re-exporting into the West. Look at what this is doing since China's announcement. It's down, it's not up. So how does that work? And then, of course, if you look at EEM, which includes China, there it is. So how is this meant to tell us that markets outside of where Xi Jinping can call the shots, how is it that none of those markets believe it?
Fair enough. All right, so let's put a fine point on this because we got a lot of topics to cover today.
Sure.
This has been a fun one, and I knew it would. And just so everybody knows, Ilya, this is Ilya's specialty. I mean, he's explicitly covered Asia and Chinese markets. Yeah, so this is why it's a fun conversation. And just to put it out there, you're not just randomly opining on this topic. It is something you have deep subject matter expertise in. I'm just winging them off the side of my desk. That said, what would you do then? Ilya, would you just completely avoid the risk and opportunity here? Because, you seem to be a bit negative. So would you fade it? Or, because all of the implied volatilities on these underlying instruments are insane, bro. They're like 90 to 100%, meaning the implied volatility is as high as it's ever been in the last 12 months. The individual implied volatilities are relatively high, saying these things could, basically increase 50% or cut in half over the next 12 months. So I think for most traders out there, if you have a directional opinion, have at it. If you've got a neutral opinion, have at it. But there, you look for instruments like this to express an opinion because you're going to get movement. So my play is I'm long the underlying stock and a lot of these underlyings, but I have been for a while, right? It's not like I'm an incremental buyer at this price level.
Right.
Today, I bought some very short-term puts on that underlying position to reduce the deltas. I don't want to sell upside calls because I don't really know where the fair value of these things normalize, and I don't want to get caught rolling and rolling and rolling. Maybe when we start looking like we're getting soft, then I start selling some calls to harvest some of this premium. That's the way I'm playing this. So, Ilya, to you, what do you do?
I think there is no reason at these levels after this massive reaction to try to look for exposure to this narrative in mainland shares. Now, if you got a pullback and that pullback started to anchor at a level, and then you had a reference point and said, okay, there was the high. Okay, now it's anchoring here. I can measure risk reward and basically say, if this is the low and a return to the high is my reasonable expectation of what a profit target looks like because it's been there before, okay, If I can structure a good risk reward bet there, take your skepticism, lock it in a box, and do what you're supposed to do, which is manage risk. Go long. And if that will, and if the risk reward is attractive, good. But you need a pullback in order for that to occur. I don't think it's wise to try to say that you're gonna short this and underestimate Xi Jinping's power to talk up domestic stock.
I totally
markets.
agree. I don't want to fade these at all.
You're asking for a sledgehammer to the head, essentially. Why would you do that? Xi Jinping can just call this thing higher. We're looking at it.
Yep.
So that's a terrible idea. I think if you wanted to have exposure to this story, the place you take it is the Aussie dollar. And the reason you take it there is, number one, it's liquid. Number two, it's not nearly as jumpy. Number three, if the markets really believe that China is back, that's the market that's going to have the most response. They are the commodity exporter of the critical stuff to China, coal and iron ore. So ingredients to make energy and ingredients to make steel. This is fundamental to China's growth engine on both counts. So if you are going to say, hey, Chinese stimulus is going to work, well, buy Aussie dollar. I wouldn't buy it here, but that's your instrument. It's near the high. It could break out. It's got room to go, and the RBA does not want to cut. It's all there for you if the markets believe. I'm on the short side of it because I think the markets don't believe. And so far, it's just idling. So it hasn't worked or not worked for me. I'm just waiting.
You know, I'll know when this thing is going to roll over when my buddies in my group chat, which we're talking, you know, we talk about random stuff, maybe, you know, sometimes politics, not really, just maybe football games and just random stuff. When they ask me, hey, Vic, should I, what's up with Chinese stocks? That's the day that I'll know we've jumped the shark. And I actually think what will be interesting, in my personal opinion, when these things reach some sort of short-term pinnacle and we do see a roll, because you know, we are going to see that. That's just how this type of move usually ends. I actually think we're going to see a down move in volatility will contract at the same time. So you're getting sort of almost like a gamma, this reflexive like gamma squeeze the upside. But once we roll, everyone's going to be selling their calls, and most likely, like me, I'll be looking to sell puts and try to harvest that elevated implied volatility. And if the market does that collectively, you'll get this sort of scenario we don't see very often, which is a market that's going down and vol's actually contracting with that move down. I think that's highly likely that's what we end up seeing.
Yes, and that's actually a very, very important caveat, right? The essence of Tasty methodology is not to sell vol when things are going higher. It's to sell vol when things are looking stressed. When vol spikes because there is some sort of irrational concern, right? Because the essence of the story is implied vol overstates realized vol most of the time because the markets get jumpy in an undue way and overreact most of the time. That's why you look for vol to recede. This is not that environment. Yeah, vol is elevated, but the price is screaming. So this is not sort of your usual Tasty methodology, short premium vol extraction kind of a thing.
Yeah.
And of course it's not. It's China. It's a very closed, very illiquid, very mandated market. It's liable to do crazy things.
I don't know. I think Alibaba, Baidu, I think some of these names have decent liquidity. That's number one. Number two, I think to anybody that's listening, this is not like we're just talking about Chinese stocks for the very first time. Anyone that's watched this show knows that a month or 2 months ago, we've been talking about several recurring themes: materials through the miners. We've been talking about nuclear stocks. We've been talking about Chinese stocks, given the cheap relative valuations and the lack of capital that has been allocated towards all of these themes. As I mentioned before, $280 stocks, of grand total of $800 billion of investable capital. Yet you've got multi-trillion dollar companies over here. You have 3.5% of the S&P 500 are allocated towards energy names in the S&P 500. Does that make sense? You know, if we're in a world of AI and EVs and digital currencies and all this stuff, does it make sense that we've only allocated as investors 3% of capital in the S&P 500 to energy? I'd probably say no. And so this is not something we're just talking about because it's the fad now. The point is, we were talking about this stuff before it ran 50% off of the lows. And I think talking about what to do with them now, I think is sort of an important part of that investing or trading life cycle versus just saying, hey, we told you so. And then we don't talk about how we're managing the risk once we get here. So in fairness.
So one of the interesting aspects of this is, and this is sort of from the deep annals of having watched APAC markets at a hyper nerd level for a very long time. There's this setup called the Stocks Connect. And what this does is it links mainland shares with Hong Kong.
Oh, yeah.
Where if you have access to mainland shares, or you're a mainland investor and you have access to Shanghai and Shenzhen, you can trade markets in Hong Kong. And markets in Hong Kong are open to the external world, which basically give you, the mainland investor, a vehicle to send your money out into the world. It also works the other way. If you have access to Hong Kong, which is, again, an internationalized market, the Stocks Connect lets you have exposure to mainland names. And so, very helpfully, you can look at the volumes going back and forth on the Stock Connect. Southbound from mainland to Hong Kong, northbound from Hong Kong back. And see if, A, there is appetite for Chinese investors to deploy money rather than hoard it, which would say they buy this story that Xi Jinping is selling. On the other hand, you would see a pickup in northbound volume because global investors will go, you know what, to your point, China has been very, very unloved as an investment destination. So much so that foreign direct investment as of the most recent quarter was down over 20% year on year. Money is fleeing China rapidly. But that's now, of course, dated. Those numbers are dated now. We don't have the most updated ones. It may be a different picture. But when you look at the Stocks Connect, it gives you a sense of, is appetite rebuilding on both sides? And you can look at this stuff day in, day out, because you get publications of this data in almost real time. And what you find is that, as a matter of fact, no, volumes are down. And so when the money comes, I will believe that the market believes. None of, by the way, the arguments that you've made, I think, are unreasonable, irrational, or not a good thesis that I'm going to argue against. They're not. The question is, do the markets want to believe that, right? Because at the end of the day, you might be right. But if the markets don't want to go there, then they won't.
Yep. I think you're right.
And so,
I just think
that's really it. Like, outside of mainland, where obviously there's a screaming rally, everything else looks circumspect.
Yep, I agree. What's wild is how just David Tepper's commentary on CNBC, and I don't know if that's the spark, but it doesn't seem like it was really the spark. Really, it seems like the Politburo, it started with the monetary stimulus, the Politburo meeting, and then David Tepper was sort of the match to like the wider investment community of like, oh wait, what are these trading at again? And they look at the valuations and they go, oh shit. And it's sort of just lit this match, which has been absolutely insane. Let's switch topics a little bit. That was a fun one. I do think for everybody out there, whether you're a directional trader or you're a vol seller, I think you got to be. I'm not saying go trade them. I'm just saying look at the vols and look at some trade construction and see if there's anything interesting, because you don't get very many instances where you're getting this level of price movement and you're getting these types of elevated vols. I mean, this is sort of a trader's dream a bit. So switching topics a little bit, Ilya, I am curious, what's your take on the East Coast port strike, and whether you see it priced anywhere? Like I'm shaking everybody I can find, Ilya, and I'm going, where is this priced?
Right.
Tell me where this is priced. I'm looking at Walmart. I'm looking at Costco. I'm looking at the shippers. I looked at a couple of the perishable staple companies. I'm looking at vols and vol differentials. I can't find it, which makes me nervous that this is just the longer this goes on, the more painful this will be, and then we'll start pricing this in, which I don't like that at all. What do you think the impact could be here, and how do you think about it as a risk or opportunity to any underlying instruments?
It'll be interesting to see how much of this ultimately has an impact, because obviously the implication at a macro level is inflationary, right? So anytime you put a stick in the spokes of commerce, the expectation is what's going to happen is the price for stuff will go up because you will disrupt supply. Demand is demand. It's not impacted by whatever stick you've stuck in the spokes. People want their stuff. And if you disrupt supply, given demand, the price will go up. So the quick answer is that the risk here is inflation.
Mm-hmm.
And it's an interesting thing to unpick in the current environment, because the market has been in a reflationary mode basically all of September. As soon as basically September started and the markets got the all clear that the Fed is going to do the cut, that basically the 18th is on and it's probably a 50 basis point cut, as soon as that happened, gold higher, curve steeper, break evens up to the highest levels since June. You name it. It's reflation everywhere. It's difficult to unpick this one strike out of that narrative, which is ongoing. The really interesting thing is the economy seems to have endorsed it. The markets are in a really interesting spot here, and I'll take a step back and just kind of paint the picture a little.
Mm-hmm.
U.S. economic data started to slow down significantly around mid-April or so. And the markets looked at it, and this was right around the time that the Fed was so very concerned that disinflation wasn't happening fast enough. And in May, they came out and said, we don't know, lack of progress. And then in June, they came out and said, okay, maybe only one cut this year. Meanwhile, the markets are looking at it and going, what are you talking about? The economic data is getting softer. You're going to miss this thing. You're going to miss the boat. And so what you see from mid-April until finally Powell in the beginning of July starts saying, okay, it's on. The markets start baking all these rate cuts in for next year, saying, well, you're going to drag your feet this year, so you'll be behind the ball, so you're going to have to do a lot next year. That's why they ultimately freak out in July when Powell says it's go time. Because by then, they'd already seen all this data, and they go, wait. Oh, so now the pain has gotten bad enough that you've noticed? Congratulations. Now that you've said that it's immediate, that means whatever economic issues you've seen them, they've arrived now. Now there's a recession risk and all this stuff. Well, the U.S. economy has shown that those concerns are, at least for now, misplaced. The U.S. economy has turned out stronger than expected. We've seen that show up in the PMIs. Just this week, the ISM numbers came out, and although the manufacturing side was soggy, we'll get the services side tomorrow. If you looked under the surface, slower deliveries, lower inventory, lower prices to stoke demand, the production index picking up, the new orders index picking up, still contracting, but at a much lower rate. You start to see these green shoots.
Mm-hmm.
U.S. jobs data outperformed this week. Job openings back over 8 million, higher than expected. The ADP numbers, suspect as they are sometimes relative to NFP, nevertheless, better than expected. So you're starting to get a sense that U.S. economic data is firming, which is feeding this reflation story where everybody goes, okay, well, now you're dumping a bunch of stimulus on an economy that isn't exactly in dire straits. It's actually doing fine. We revised second quarter GDP to 3%. That was higher. And if you believe the Atlanta Fed, we're tracking somewhere around 2.5 for third quarter. Solid. A little bit slower, but solid. And now you, in the next 48 hours, you're looking at the service sector ISM, but most importantly, the jobs report on Friday.
Mm-hmm.
And the question that you ask yourself is, okay, so what happens if all this economic positivity endures, we get hotter than expected or even just a bit warmer ISM and jobs data, and suddenly 100 basis points in cuts or 125 basis points in cuts next year no longer makes sense.
Which, by the way, Larry Fink, in an interview with Bloomberg, I think it was yesterday, that's exactly what he said. He said,
that's right.
The market is on crack. There's, he sees no sign. He thinks that the market is priced in too many cuts into the forward curve.
Right. Well, this is the crazy thing, right? The markets ran away with baking in all these cuts when the data was telling them the Fed is behind the curve. There might be a recession. Powell just told us this week, you all are nuts. We're not behind the curve. We feel that we're fine. We don't need to be in a hurry. And by the way, our risk is two-sided. It's not like we've gone from a solitary focus on inflation the past 2.5 years to now a solitary focus on jobs. No, we just think our risks are now in balance. So it's not like the Fed doesn't want to get to 2% inflation. They do. And it's not like they've completely abandoned caring about how they get there. So you see inflation expectations pick up. You see reflation dynamics in markets. You see that underpinned by stronger U.S. growth. Number one, you get a possible surprise risk to things like crude oil. That could get shot higher if there is a demand story there. And a much more credible one than the hopium in China. For one thing, China buys all its crude recently at deep discount from Russia.
From Russia.
Yeah. One's got to sell and the other's happy to buy.
Yeah.
And I would not be surprised. Let me get my Reynolds wrap out here. I would not be surprised if this is done with tacit approval from the West, because if China were to go to market and buy the crude there, that would be an inflationary influence, and both Europe and the US are trying to fight inflation. So they want for there not to be a giant gorilla of a buyer in commodities. Whatever China can buy at cut rate prices from Russia, good. That's less inflationary influence for everybody else. So as you look at all of this and you say, okay, well, China, it may work, it may not, but a returning U.S. economy, that might be a positive shock to crude for much longer lasting reasons than episodic Middle East back and forth. So there, yes, but also higher on the long end rates, lower on the bonds. Also stronger on the US dollar, because that's a yield spread adjustment in the dollar's favor, especially against the euro, where the economy is falling apart. And the ECB is going to have to do a lot more.
Yeah.
So you start to then, the read through then to stocks is, wouldn't stocks like a stronger economy? And the answer is maybe not. Maybe not. Because if you take away the magic juice, maybe they're overcooked here.
Right. Because what the market liked for the last whatever amount of time was what you saw happening in the yield curve.
More
and now
magic juice.
when you're actually going to get strong economic data, you're getting the opposite while that's happening. Again, we've talked about this, like these
we've seen this before. There's like good is bad, bad is good. Like
it's just
the
sine waves of the real economy and the sine wave of the financial economy are sort of offset. And so you're playing both in a way. But to your point, if there's too many cuts priced in, what happens is the short end of the yield curve comes up. And if the short end of the yield curve comes up, what do you do with the long end of the yield curve? Does it going to invert more because you think that that's going to cause a recession? Or is it going to say, hey, well, I see this growth. I see this, a little bit of inflation running above Fed's target, and you get a lifting of the long end of the curve as well. And how do you price all of that in at the same time? To your point, because you're not getting the euphoria of cheaper money, you're getting kind of tighter conditions.
Yes.
At the same time, you're getting stronger economy.
There's also an interesting caveat that the Economist brought up. So full credit to them. They unpacked this. That there was an article in The Economist, I want to say 2 weeks ago, maybe 3, and I've been wantonly sharing the chart that they put in there. And they show the past 9 tightening cycles since the dollar came off gold. So they're going back to 1972, essentially the advent of the modern fiat-based financial markets.
Okay.
And what they do is they relate the depth of tightening, so how much tightening there was, to credit outlays, interest payments by non-financial companies, so regular economy companies, because of course the banks would have a different narrative in that kind of an environment. But you look at non-financial companies and you say, well, what the Fed is supposed to be doing when it raises rates is make credit more expensive, because the idea is you want to say, hey, companies and individuals and households, spend less, save more. Credit is more expensive, so we're disincentivizing you from spending money, especially borrowed money, because we want economic activity to cool, because we want inflation reined in. The quintessential idea is to slow growth by making credit outlays more expensive. That was the case in every single tightening cycle except this one. In this tightening cycle, credit outlays have so far fallen as rates have gone up. And The Economist explains why. He goes, well, look it. How much money did companies save by not spending during COVID lockdowns? A lot. Everything was closed. Where were rates at the time? 0. How cheaply could they finance themselves 5 years forward? Almost free. And these corporate loans tend to have about a 3 to 5 year rollover. Even if the Fed were to cut 300 basis points next year, if you're a company that took out credit and was stacking cash during COVID at basically interest rate 0, your refinancing is coming up right about now. And you're going to have to refinance at higher rates, even if the Fed does all the cuts they've done and then double that. Either way. So, okay, you're not refinancing from 0 to 5, you're refinancing from 0 to 4 or 0 to 3% Fed funds. But you're refinancing 200, 300, 400 times the credit cost as what you incurred when you took out this financing.
Fair, but don't you think the market is already? I hate to say this, but because I want to make this actionable here in a second. I want to take a turn and make this actionable. But don't you think if a company has high debt levels, the market sees their refinancing coming, that it's priced into the equity, and that it's also priced into their cost of borrowing, and that in a way the market is sort of all dealt with that, right? We haven't seen
If that were true, the global financial crisis of 2008 would have never happened.
I'm not
if the markets
saying...
were that forward thinking all the time.
Right.
We don't know. I mean, I'm not saying there's going to be a credit crisis. What I'm saying is the markets are in a sensitive place whereby higher cost of borrowing dials up sensitivities that may or may not be an issue at a time when asset prices are at record highs.
I'm going to be careful.
Somebody out there is going to go, this is a little rich given a dialing up, even incrementally, of risk. Let me back up.
That's fair. What I'm trying to say is not that there will not be impacts, right? We've already seen higher levels of bankruptcies. We've already seen layoffs. So we're starting to see. I'm not saying just because the equities are priced and because that some participants have higher borrowing costs. I'm not saying that that's reflected in the unemployment level or claims or, I'm not saying that. And those impacts have, those will impact the market. So let me do this.
Right. And the economy is looking good for all of everybody's concerns, including my own. So far, the economy is looking good.
Yeah. I think the macro narrative, though, it's just, a couple months ago, it's like this thing's going to roll over, the Fed's behind, and then a couple months forward, and
I'll tell you why.
We're in a no landing scenario, and I think it's very likely we continue to see that type of oscillation here into the coming months. I don't think that goes away. I think the narrative might be positive today, and in 6 weeks, Ilya, we could be having this conversation, and everyone thinks the world's ending.
That's right. There's a really interesting way to unpick this, and I've done it granularly on Macro Money with pictures. I don't have the benefit of pictures here, but I'll try to make this as straightforward as possible. When you look at the outlook for Fed policy as it is baked into Fed funds futures, and you say, you know what, I'm going to look at the implied rate Z 2025, December 2025 contract Fed funds, right? I want to look at where the Fed is going this year and next, look at what that implied rate is and how much of a rate cut cycle is being implied there. If you look at that and relate it to stocks, it's very easy to say the Fed is irrelevant. Because what happens is sometimes these things move together, sometimes they move inversely. So it's very easy. And they go through sections. There is a big section from October, November to January where they move inversely. More easing, stocks higher. Then there is a big section from about February into April-ish where you get fewer rate cuts in the outlook and stocks still go higher. And then you get a section therefrom where, again, more easing, stocks go higher until July, where, again, dovish is bad. So they go through these multi-month sort of flips almost, where the relationship inverts. And it doesn't make sense unless you look at how the economic data is performing at the same time.
So in
the beginning of the year, they go, oh, well, the data is getting better. The economy is getting stronger, hence the Fed being slow. Okay, these are fewer cuts for good reasons. So that's okay. Stocks can keep going higher. As of July, dovish is bad because now we think that there's a recession risk. It seems like it's flipping again now, and the question will be, are you going to get back to a beginning of this year sort of a scenario where you can get fewer cuts in the outlook and higher stocks? Or are you going into a thing that's more like exactly a year ago, October, November last year into January, where fewer cuts is bad? It's really all down to the data.
Let me ask you this, because I've got the yield curve up on the screen just so people can see the visual shape of the curve. I really just want to ask you about your bond positioning, if you have any.
Yeah.
Which is how you think about the 2-year here. You've said there's the potential for the market that the market has perhaps overpriced cuts. I wonder if you think that has potential implications for the 2-year, whether or not you'd be shorting the 2-year, which, bond price moves opposite of yield. If you're short the bond price, yield would be moving higher. And so that would be the implications if you think the market has priced too many cuts into the short end of the curve. And then, a few months ago, prior to the cut, I think you guys had sort of run. You rode the wave of TLT. So as the long end of the curve,
my best trade so far this year.
As the long end of the curve was coming down, bond prices were going up. I'm curious how you think about both the short end of the curve here and the long end of the curve, whether you have any positioning at all, and how you'd play it, into, I don't know, the next expiration cycle.
I don't have positioning directly in the bonds at the moment. I do have exposure to reflation by being short yen. So essentially what I'm doing is saying things that don't yield anything are not going to do well in an environment where you're talking about reflation and the expectation for higher rates and the dilution of Fed rate cut bets for next year to some extent. Not completely, obviously. At least until, let's call it, December, when the Fed is going to give us a new SEP. It sounds like the Fed is all the way locked in for November, for December, for a 25 basis point cut on each. Powell was so uncharacteristically candid about that on Monday. It was almost like, I don't even care to hide this from you. That's how obvious it is. At the press conference after the FOMC announcement, Steve Leisman, I think, from CNBC asked him, so if we want to know where things are going next, what are you looking at? And Powell just deadpans, well, look at the SEP. After years of saying, don't take the SEP at face value, it's just people that write down their forecasts.
They always downplay this SEP. They basically don't take this too seriously. These are just, random guesses. We have no idea.
A bunch of guys walked into a room and gals wrote some stuff down on a piece of paper. It's all good, baby. Don't worry about it. And here Powell was like, what do you mean where it's going? Have you read the SEP? Where have you been?
All right, this is what makes you a terrific dancing partner. So you just brought up your positioning in the yen, and I guess if people aren't following what's been happening in Japan from a monetary policy standpoint, there's been a few developments over the last week. I wonder, bring everybody up to speed on what exactly is happening over there and how it impacts price and how it impacts how we should think about the yen moving forward.
Sure. And lest I sound like a presidential debate participant, let me circle back to your actual question and answer it. I don't have direct exposure in the bonds. I do want to be long the long end eventually, because it is a rate cut cycle that we're in. I just think we need to kind of get to a better place on it. We need to have the long end.
That. You and Chris, and that's what makes me so damn scared.
Not here though. Chris is already long. I am not doing that yet.
Because I have a ton of respect for you guys and your opinions, and I just don't see it. I have no idea why anyone would want to be long the long end unless this whole thing rolls over, right? Unless. Because the narrative is that they baked in too many cuts. So the short end should come up. And if the short end comes up, the long end should go up. No,
I agree with you, which is why I'm not there. I philosophically think that in a multi-year cutting cycle, bonds are biased higher. I am not seeing anything in the price action that makes me want to take that view and have risk in it.
Fair.
If it comes down and it looks attractive and the risk reward is good, la-di-da. But I am not looking for any exposure there. Instead, as I say, I'm short yen. because yen is an asset that tends to be weak when interest rates are going up. So essentially, I have a bet on bonds going down and rates going up, just not in the bonds themselves.
Fair.
Now
So what,
I will
so
tell
what's the
you a
political
story of
and-
the yen.
Yes, the political and monetary sort of updates since the last time we talked last week, because there have been a few. Bring me up to
Yes.
speed.
So the situation in Japan has worked basically thus. In Japan, historically, you have a terrible demographic issue. They are the oldest population in the world, way past the average age population-wise where peak consumption is. And so they have not, because of their demographics, had any economic growth for quite a while. They're aging very rapidly. There's no consumption. Because there's no consumption, there's no growth. Because there's no growth, there's no inflation. Interest rates have been going down basically for 4 decades. And they've been basically pinned to zero now for quite a long time. That has made it attractive, both for people in Japan and outside of Japan, to say, I am going to go borrow in yen because the interest rate I'm paying is next to zero. And then I'm going to take that borrowed yen, sell it, and buy with it other assets denominated in other currencies that pay a higher interest rate, bonds that pay a higher interest rate, stocks that pay a higher dividend yield. And it's not hard to find, considering the benchmark is zero for what you're paying on your borrowing in Japan. So anytime it's risk on and people want to buy risky assets, they go, well, what's a way that I can finance this for basically nothing? I can finance it in yen.
Mm-hmm.
And this has been a strategy called the carry strategy, which has existed now for decades because of this situation in Japan. Fast forward to COVID, and Japan finds itself in an interesting spot. Japan is an island. It imports over 60% of its food. It imports almost all of its energy versus making it domestically, especially after they shut down big chunks of nuclear power following the Fukushima disaster some years back. So Japan is very sensitive to the buying power of the yen. Japan has had inflation show up just like everywhere else in the world as a function of COVID because of broken supply chains and because food prices, energy prices, prices for all kinds of things went out of whack almost everywhere. US, Europe, you name it. Inflation was an issue everywhere. Japan didn't, by the way, have a big fiscal stimulus effort on par with Europe and the US. They still had a giant inflationary spike, most of it imported, most of it because of food and energy. So Japan looks at this and everybody goes, okay, well, now it's time for them to maybe hike rates because inflation is finally high. And for the longest time, Japan was saying, yeah, but this is like episodic inflation. This is not like people really spending. This is the wrong kind of inflation. And they resisted for a long time. And then there seemed to have been a head change where they brought in a new head of the Bank of Japan, not from the orthodoxy of the Ministry of Finance, not from the ranks of the BOJ. They brought in an academic with an appetite to do out of institutional consensus type of things and said the yen needs to have more purchasing power for these imported goods. Otherwise, this inflation isn't coming down. People are hurting. And what they've started to do is normalize monetary policy. Come off zero, slowly. And there's been tons and tons of speculation, including by yours truly here, that in a global easing cycle this year, where everybody's cutting except Japan, which is cautiously hiking, the yen should surge. It took a really long time and subjected some of us to enormous pain. And then it all finally happened. And the yen just roared higher.
Mm-hmm.
They just had an election in Japan because, against the backdrop of all of these shenanigans, the prime minister, Kishida, had record low approval ratings, and he basically stepped down and said, I'm out. I've lost my mandate. So the ruling LDP party, of which he was, had to have a leadership contest, have a new ruler who would be the de facto prime minister. And the two leading candidates, one was saying the BOJ is nuts. They should stop all of this hiking. All of our long-term issues remain. Just let all of this other inflation work itself out. By the way, it's already down a lot. If you look at, for example, food prices as measured by the United Nations FAO, way down. And you can see how that, with about a 4 to 6 month lag, shows up in inflation in Japan, shows up in inflation in Europe. It's crystal clear. So one candidate is saying, stop it. Another candidate is saying, no, the BOJ is right. They should normalize. We need to rebuild consumption and the capacity to consume. And the latter one won. So the BOJ basically got a friendly fiscal backstory where the new prime minister is saying, yes, go ahead, hike. Do your thing. Normalize. And in response, the yen shot higher.
Mm-hmm.
What has happened since then is it's come right back. His name, by the way, Shigeru Ishiba. I hope I'm pronouncing that correctly. He doesn't really change the status quo because, of course, the outgoing administration had the same view. And so my sense here was, we'll just wait it out. Yes, the yen got weak here for a bit, but maybe this will still have legs, essentially, because we're still in a reflation story, and the shock that you got from this guy coming in saying, no, go ahead, hike, that's not the real thing, because that ultimately doesn't change anything. The Bank of Japan was already on that path to hike, and in any case, they had a big 10 basis points in further hikes priced in through all of next year.
Mm-hmm.
Their rates are at 0.25% right now. Oh no, they'll go to 35 basis points. What a horrible tightening. No. And so if you have global reflation and rates higher, you should still get a weaker yen. And so what you see on the chart here is the yen starts coming down, then you get this violent spike down, then up, and now it's come back down and it's actually setting lower lows. So I'm long dollar yen spot because managing risk in 6J just proved way too big for me at the beginning of the year. And there's really not a liquid micro future here or a liquid ETF that we have, like FXY, say. And so what I've done instead is just taken my ball and gone to spot markets where you can reduce position size lower and be a little bit more flexible. So what I have here is effectively short 6J exposure, only I'm doing it by being long dollar yen spot. But it's exactly the same idea. And I'm holding it on the idea that reflation and fewer rate cuts from the US means that you reignite the desire to want to borrow in yen to buy higher relative yields in the US, and that this is yen negative against the dollar.
Interesting. Okay. So basically, yen carry back on.
Against the dollar, saying. At least.
Yen carry
it
back
may not
on
be,
against the dollar.
It may not do as well against the euro because of the eurozone issues. It may not do as well against, let's say this was franc or maybe even the pound because of their own issues. But if the main kind of adjustment in the Fed, and the Fed is, of course, the barometer for global borrowing costs because of how ubiquitous the dollar is in global commerce, where essentially if the Fed is hiking, they're raising the cost of borrowing on all economic activity because almost all of it is done in dollars. If the Fed cuts, it's the same thing because the dollar is the vehicle. So what the Fed is doing is it's changing the cost of borrowing dollars, but dollars are the global commercial currency. So what the Fed is doing is it's changing the cost of borrowing, the medium of global exchange. So the idea is that if the Fed is going to reduce that less, then the markets are misaligned, and the yen should be weaker for a more pronounced spread between the dollar and yen rates wise.
So you're nothing if not consistent. So this is basically consistent with your views on the 2-year. It's consistent with your views on where Fed fund futures are priced. So that's what goes back to the conversation when I asked you, do you have an explicit position? You said no, but, and you gave an amazing, very eloquent explanation as to how you get to your current, basically implied short 6J position. The last question I'll ask you before we end on something I guess kind of fun. I don't know, maybe my idea of fun is a bit warped. My question is, I don't know if you do price targets. I don't know that I do necessarily, but if you're taking an implied short position in 6J, would you expect us to plumb new lows here? Or are you basically thinking that this is a retracement move of those lows off of early June?
It seems like more of a retracement move. And where that comes from is, again, this philosophical idea, right, that we're in a global easing cycle. And that what's going on with the US isn't so much, oh, the economy is bad or something is going to hit the fan. I mean, maybe, but there's no evidence of it. It's all a hypothetical. Like maybe we hit a refinancing wall and something dies along the way. I don't know. But what we look at here and we say, oh, the yen thrives when we are in a global tightening cycle because yield spreads are widening against it, encouraging people to borrow and short yen because rates on other things look more attractive. If we're in a global easing cycle, it's the other way around. So in my mind, this is more corrective than it is a trend, but how far? Who knows? Who knows? I don't think we set lower lows. So I don't think we come back to levels from July and then go lower. I think that's probably asking more than what is reasonable. But getting back to, let's say, 67 or 65,
that's what I was going to say. 50% retracement probably put you around 66 range. So let me do this with the last couple of minutes. We were joking around in the green room before we came in. We got 5 minutes. I usually save all the political stuff to the end. Shout out to everybody who's still around with us.
Took a little jab at him earlier just to presage this.
Yeah, you did. Do me a favor, everybody, as we start to have a little fun with our conversation. And have a quasi-political discussion. Hit the like button. If you're easily triggered and you don't necessarily want to discuss the vice presidential debate from yesterday evening, feel free to sign off, and we thank you for listening for 85 minutes.
Yes.
Ilya Spivak, my good friend, I'm very aware that you did watch the vice presidential debate. I don't think it was market moving in any way, shape, or form. But I'm curious just to get your feedback, open-ended question on the vice presidential debate from last night.
I don't think it moved the needle whatsoever. I think it was for me as an American, it was an encouraging thing that it was civil, that there were points of agreement where one vice presidential candidate said to the other back and forth, I think you are approaching this in good faith, and I think that's a solid idea, and that's a solid idea, and we could work on these things, and there's areas of overlap where we can do something. I thought that was all very encouraging, and everybody, both of them tried to kind of score political points against each other, but in a more, dare I say, conventional debate format than we've seen in recent years. It was more policy oriented, less personal attacks oriented. And both of them, of course, did some of that. I don't think this moves the needle whatsoever on the election outcome. I think this will be an interesting thing where everybody that had their pick already, and I think that's most people, they found things to like about their own side. I don't think anybody undecided became decided on the basis of that. Like, if you're still undecided now, given how known a quantity this choice is at this point, considering, of course, that at least one of these people has already been the president for 4 years, the other one has already been VP for the next 4 years, you know where you're going here. The choice is not, it's not like you don't know sort of what the basic differences are. So if you're still undecided, that was not the debate that solved it for you. I think if I had to sort of extract anything out of this, it's how different it was stylistically, and how that difference stylistically was primarily defined by the absence of Donald Trump, whose style is very different than what we've seen in political debates before. And for example, in 2016, it was an incredibly effective stylistic difference. We can see that in his debate with Biden earlier this year, a very effective stylistic difference. We see that in the debate with Kamala Harris, that didn't play to his advantage. So that kind of assertive, almost bullying type of style, it didn't work. So this debate was much more kind of traditional-ish in its thing. And I think what that does, if anything, is it underscores, again, the differences in style in the campaign at the top of the ticket.
Who won?
It's a difficult question to answer depending on your criteria. I think if, speaking completely subjectively, not wearing my markets hat, because I think from a markets perspective, who cares? It doesn't matter. I don't think anybody's needle moved market wise. For me personally, I think JD Vance was the smoother speaker. He presented himself more eloquently. I think on policy substance, you heard much more of that from Governor Walz.
That's what, if I could give you my response, that's what that's what the losing side of a debate always says. Like, I feel like Harris won the presidential debate, and what I heard from Trump supporters is that Trump won on substance, but that Harris won sort of. I don't know the articulation.
In fairness.
And so I think if I'm calling it, I think Harris won the first. I think Trump won the first presidential debate against Biden. Wasn't even close. I think Harris won,
and Biden subsequently left the race to kind of.
I think Harris
underscore the point.
The second presidential debate, and I don't think that was close. I think you know, moderator bias, whatever. But I just call it, the end score is what matters, and I think
yes.
I think he lost, and I think JD Vance mopped the floor with Walz last
Here's
night.
why I think that didn't happen.
Okay, well, real quick before you do.
Yeah.
So I think to your point of civility, and I think a lot of people have said that, there's a part of me that does agree with it, and then there's another part of me that goes, "What a low bar!" You know, what part of us remembers American exceptionalism? What part of us remembers that we have great ingenuity, that we have the ability to be disagreeable, that our principles of free speech and the ability to believe different things, but to understand that we all have positive intent about the future that we're trying to build for ourselves and future generations? What part of us have forgotten that we set the bar so so goddamn low that we jump over the envelope, and when we see two individuals have a discussion that looks anything in the ballpark of civil, all of a sudden we commend ourselves, or at least commend the two gentlemen. And I do think it is a breath of fresh air, because we have forgotten that that is what politics, American politics, can be at its largest and highest aspiration. The second thing is that it is, in my personal opinion, a bit of a disappointment that the articulation of policy and speaking to the issues that actually impact everyday Americans was more apparent in the vice presidential debate than in the actual presidential debate. That in the presidential debate,
walking into proving me right.
That both that in the presidential debate, both individuals were unable, I think, to really articulate, their vision. I think, one side is completely rehearsed, and you're regurgitating something I can tell you've practiced 100 times in the mirror, and the other side sort of is saying the same sort of very superficial 7-word sentences instead of getting down into the meat and the gristle with statistics to back up these claims. The third thing is, I would agree with you, it probably didn't move the needle, but the vice presidential debate probably doesn't. However, I would say that, like, the greatest irony is, if you didn't really understand where these people stood in terms of their politics, both sides of the ticket, you ended up getting a better articulation from the vice presidential debate of where both sides stand on these issues. If you didn't go in and read Kamala Harris and Walz's 82-page economic policy papers, if you didn't go read a lot of the stuff, you got an actual articulation, which I enjoyed. And the fourth thing is just the who won. I'm trying to be objective here and impartial. Dude, I don't even think it was close. On substance, I don't think it was close. On style, I don't think it was close. And I think there was a couple of there's a couple of things I didn't like about J.D. Vance. I thought he was talking about energy policy of Kamala Harris. If I had to say what I thought what I think he didn't do so well, he spoke to the energy policies of Harris and Biden as if they haven't increased energy production,
record output.
And I never like when I don't like it when Harris obfuscates or lies about Trump's side of the ticket, and I equally don't like it when one side does it to the other. And so there was a part of me that knows the statistics behind that, and I didn't like that was using a point that I could point to and say this is factually incorrect. So, but I didn't think it was close, man. Anyways.
So the only last thing I'll say about this is, for all of the reasons that you've just listed, I think this debate might have been a loss for the Republican ticket. Everything you've just said, we've set the bar so low, shouldn't we expect civility? We got civility. We had a much more substantive conversation about policy.
I know where you're going to go. And so where I would go as a counterpoint, just because I'm going to speed this up, what you're going to say is that is a feature of Trump's sort of his mannerisms in politics. So let me, just because I want to get out of here.
It demonstrated with very clear relief everything that Donald Trump's style isn't.
So
and by the way, maybe you like that style.
Yeah.
And that's fine. Who hasn't made their mind up on whether they do or don't?
Here's my thing. I would actually agree with you that there's a style there, right? The nicknames and the slogans, all that stuff was introduced to politics in 2016, and it was novel. And because it was novel, it was positively rewarded with news headlines and sort of reinforced in that way as a way to get a message out. I actually think the public is beyond that. I don't think they want the nicknames and the slogans anymore. They just want effective policy. Now, the flip side is, what I think people that make that argument do is they completely it's like this one-sided argument, when the reality is that Hillary Clinton, when she was on the debate stage with Bernie Sanders, and she sort of pressed him and sort of insinuated that he was racist, or put him in this box where it could insinuate he was racist, it won. It won. And I think there was like a moment there that they realized, the Hillary Clinton campaign realized, that they could sort of utilize this. And I think since that period, One side is using nicknames and slogans, and the other side is using massive division, right? Whether it's racism, sexism, transphobia, xenophobia, anti-Semitism, there is like this massive campaign that also helps to create a culture of division, of anger, of finger pointing, and I think there's one side that has a style that's doing it this way, which you're correctly pointing out, and I'm acknowledging. There's another style that we're completely, I think there's a side that's completely ignoring, which is that is an element that's creating a toxic environment just as well. And I can point to a ton of instances where that's used on the debate stage. It's subtle, it's sort of passive aggressive, but it is a whistle to a community of people that want to be angry and that want to call people racist and they want to call them xenophobic and they want to call them anti-Semitic. And the reality is, I think we live in an environment that's much different than that. The producer going to get pissed. I don't know. We got a 90-minute discussion, and somehow that still wasn't enough, Ilya. If the people want more from you, tell them where they can go. God dang it, man.
We still can't do it. Give us 2 hours. We'll fill that.
Matt just goes, we'll talk. We're going to the dog.
We'll fill that. I'm all over the Tasty Live network Monday through Thursday in the afternoons. It's Overtime and Macro Money. On Wednesdays, you and I are here now for 90 minutes. You and I are also on with Tom for First Call Sundays. I'm on with Chris for Futures Power Hour. I'm writing for the News and Insights portion of tastylive.com, and I'm mouthing off on the platform formerly known as Twitter at Ilya Spivak.
You are the man, Ilya. I'm telling you, bro. The conversations I have with you and Chris are fantastic. In my personal opinion, I'm going to go back and watch the yen part of this discussion, because as I was watching you lay that out, man, it was absolutely masterful, and you stuck the landing. It was beautiful. I appreciate all the knowledge you share with me and everyone here. Hit the like button on your way out of the door. We'll see you back here tomorrow. Same time, same place, same great network, only on Tasty Live. Peace.